All right, all right, all right. Okay, good evening, everyone. Good evening, team. Good evening, Leap. Welcome to our Monday night product training night. Okay, this is becoming our routine Monday training. So for the last 4 weeks, 5 weeks, okay, we've been learning about the IUL Transamerica. Okay, we learned the basics of how to sell life insurance, the riders and all that, the cost. So we learned about those. Now, for tonight, it's time to up our game a little bit. Okay. Yes, it's a life insurance product to protect families and all that, but it's the same IUL, okay, and same company with Transamerica that you can actually use for business, okay, not just for families but also for business too. And tonight you're not gonna master everything, but I think at least you know that it applies, and at least we know how to start the conversation. Okay, so that's the whole point. The whole point tonight is, okay, what's a business insurance? What's a buy and sell agreement? What's an executive bonus? A key employee benefit? Okay, and how does it apply for business owners? How do you start conversations and all that? So we're in for a treat tonight. Rick, again, take it away.
There we go. I probably should unmute myself. Yeah, Donna, thanks. It's good to be with you guys again. This is becoming a Monday night tradition, which is awesome. I appreciate you guys having me back. So what we want to do tonight, and if you've been with us for the last 4 or 5 weeks, just like Don mentioned, we're kind of transitioning into learning about the specific product and the details and kind of what the product is, and now we're kind of jumping into how we can use it. Last week we talked about juvenile policies, right? And this week we're going to talk about business insurance. And here's what I'm going to really try hard to do is I want to stay high level. I don't want to get too far in the weeds where people are getting confused. I know there's a lot of potentially new people, or maybe this topic is relatively new to you. So we're not gonna dive too far down into the weeds tonight, but as Donna mentioned, we want to make sure you at least maybe come away with what's the difference between key employee and executive bonuses and things like that, and really maybe how to start talking to some of those business owners. We're going to talk a little bit about that here. So one thing I want to show you right now, okay, I know we've been here a couple of times. I'm going to share my screen here. And I want to really quickly, I've shared this website with you before, but I want to make sure you write this down. So write down or take a picture of it, transamerica.com/agent-central. Okay. Again, this is everything and anything you need to know about Transamerica. And if you need to go back and reference some of the things that we're talking about tonight, if you'll come to this tab right here called Resources, okay, you're going to see a lot of things that we've talked about. And one of them is tonight, small business planning. If I click on Learn More, you're going to see the opportunity, key employee life insurance, executive benefits. So there's basically a review right here for you, okay? But we're going to kind of get into it tonight, but I want you to come back and kind of, when you have time on your own, go back and just kind of study this on your own a little bit, because we are not going to get through everything that this has to offer in the next 45 minutes to hours. We're just not. There's a lot to cover, okay? But this is a really good spot to go back to on your own time. All right, we're going to dive in to business planning using life insurance. One of the first things I'm going to tell you, because people get confused, when we say executive bonus or key employee, it is not a product, right? In other words, you're not going to call Transamerica and say, "Hey, Transamerica, show me your key employee life insurance policy," right? It's simply a strategy that we use using life insurance. So we're still going to be using the the FFIUL or the term LB, those are the same products we're going to use. We're just using them inside of a strategy, whether it be key employee, buy-sell agreements, executive bonuses. Okay, so we'll talk more about that. All right, so this is kind of what we're going to go over today. We're going to I'm going to share a little bit about the small business world in the U.S., okay, and the different needs for life insurance inside of it. And then we'll talk about the employer-owned life insurance. What are the rules that we have to follow? Okay, and then as Don mentioned, we're going to get into key employee life insurance, executive. You're going to see there's different terms that you're going to see, right? One, I like to use executive bonus. That's kind of what we use, but you'll also hear it referred to as executive benefits, same thing, okay? And then we'll get into a little bit of the business succession or those buy-sell agreements towards the end, okay? All right, so I'm going to come back to this slide as well when we get back to when we get to the end. But I want you to kind of think about small business owners as your friends, right? Because here's, I always tell people inside of the WFG world that it can be a little nerve-wracking trying to go and talking to small business owners, right? Hey, they own their own business. They're probably a lot smarter than I am. And I'm telling you, that's simply, for the most part, not the case, especially when it comes to these strategies, right? They're out there running their own businesses, and a lot of times they forget to take care of their businesses when it comes to these type of things, okay? So a lot of these business owners simply have no idea what key employee or executive bonus, or maybe they've heard it, but they've never talked to anybody. And so the number one thing I want you to understand is we just got to open our mouths and start talking to these business owners, okay? And here's what can happen. You start thinking about all the different things that could happen when you just open your mouth, right? You could look at 1, 2, 3, and 4, and 5. You could walk into a small business, sit down and talk to the owners, right? And come away with 1, 2, 3, 4, 5 different policies, because not only are you there to talk about their business, right? But they also potentially have families, right? So you're not only talking to them about, like, for number one, you're going to go in there and we're just going to ask questions like, hey, do you have key employees that if something were to happen to them, it would be a detriment to the business, right? Most small businesses have at least 1 or 2 people that if they were to be lost, if something were to happen to them, their business is going to suffer, right? So hey, let me talk to you about our key employee offerings that we have, right? Or number 2, attracting and retaining top talent. Hey, we know you have 401ks, for example, or maybe a pension, but whatever the case is. But what if we could do something a little more for those individuals to not only attract but retain that top talent? And we're going to talk more about that, okay? But then you think about their own personal legacies that they want to leave for their families, right? So we talk about those opportunities, all the way to number 5, where, hey, I know you got 2 or 3 owners, co-owners with you. Have you guys ever talked about what would happen if something negative were to happen to one of you? And so there's all these different opportunities just by opening your mouths and talking to one person, okay? We're going to talk about all those tonight. So if you think about the U.S. Small Business Administration and how they define a small business here in the U.S., can anybody unmute and just take a guess? And maybe but how many employees can a business have and still be considered a small business in the U.S.? Anybody know?
Less than 50?
Say that again, Donna.
Less than 50?
Okay, so Donna says less than 50. Anybody else know?
Two.
Okay, I didn't know what Sherry said, but here. So Donna, it's actually a little more than that. Okay, so in the U.S., If a business has 500 employees or less, they are still considered a small business in the US. Okay. Now, this threshold varies around the world. Okay. For example, in Europe, it's what Don said. It's 50 employees or less in Europe. If you go to Australia, it's 10. It's only 10 employees to be considered a small business. Okay. But regardless of where you are in the world, small businesses have always been the backbone of our macro economy. Okay. Whether you have 1 employee or 500 employees, there are these business strategies that have to be considered and need to be used by these business owners. Okay. You look at the stat there, 99.9% of businesses in the US are comprised of 31.7 million small businesses, which accounts for almost 50%, 47.1% of the private workforce, all the employees in the country. Okay, that's kind of crazy to think about. Now, the financial cost to a business owner, if I own my own business, there's a lot of cost to that, right? When you talk about hiring new employees, the cost can be super staggering when you stop and think about it. And you see some of these numbers. You look at this Gallup study that we did, discovered that 51% of US employees are actively looking for a new job, right? Most of us have had a real job, right? We've all had a 9-to-5 job. And most of us have been in that position where, man, I don't really like this job. I'm constantly looking for something else, right? That is how most employees are, right? They are constantly looking for new jobs. And that right there is a big cost to employers out there, okay? And you can see there, Forbes indicates that 1 trillion annually is lost by US businesses due to employee turnover, okay? And losing an employee can cost up to 213% of that salary for a highly trained position. Okay, so what can we do about that, right? To help attract and retain long-term employees, it is essential that we help these business owners help their employees or help them offer these benefits and perks that we're going to talk about tonight. Okay, healthcare, retirement plans, they've all become the norm in employee benefit packages, but what if we could do something just a little bit more to add on to that to really help retain those key employees? Okay, so just a few more stats and we're going to get into this. So if you think about the reality when it comes to inadequate planning, okay, without adequate planning, a business that took years to build can be quickly lost, okay? And the goal of really passing on a business to future generations could become a nightmare if an owner dies or one of the owner dies and the family doesn't have those funds in place to continue that legacy of the business, okay? Really dashing the hopes of leaving that to future generations. You look at some of the stats here, right? 80 to 90% of the world's businesses are family owned, okay? And then some of these just become kind of crazy to think about. You look at the third bullet point there, okay? 30% of family owned businesses exist beyond the founder's life. Only 12% survive through the 3rd generation, okay? So these statistics really show how difficult it can be for a family business to survive through multiple generations. And so to help protect the business, we got to start thinking about a solid continuity strategy that should be put in place before a catastrophic event takes place, okay? So life insurance can really play a critical role in succession planning, right? To ensure that money is going to be available to that surviving family, to the surviving family of the member that passed away. Okay, we're going to dive into these details here in a second. But first, let's talk about what we call employer-owned life insurance. Okay, you're going to hear it referred to as EOLI. Okay, it's just simply employee-owned life insurance. Many businesses own life insurance to protect the business. Okay, there are several different reasons why they may want to own life insurance on an employee or a past employee. Okay? It could be they want to safeguard the business from that potential negative financial impact due to an unexpected death. It could be they want to attract and retain key employees and that top talent that we've talked about. Regardless of the regardless of the business need for that life insurance, there are requirements that need to be met. Okay, for disclosure, for consent, and even reporting. Okay, and so failure, if we fail to abide by these requirements, it can result in that death benefit or those death benefit proceeds being taxable to the employer. Okay, so EOLI is simply a life insurance policy that is owned by the business on the life of a current employee, where the business is the beneficiary. We're gonna dive into that. Okay, but here again, I don't want to get too far in the weeds. This is probably about as far as we're going to get into the weeds. But I just want you to understand that when we talk about employer-owned life insurance, there are a couple rules that we have to follow. Okay. The first thing I want to show you here is the very top where it says IRC section 101J. Okay. Just think of that as another word for employer-owned life. This is kind of the tax code. Okay. And so if you ever hear anybody talk about IRC 101J, it is talking about these rules that we have to follow. Okay. And the one that I want you to write down, okay, and the one that I want you to understand the most is really the third bullet point. Okay. There are requirements for notice to and consent from the insured employee must be met prior to the issuance of the life insurance policy. In other words, I can't just write a life insurance policy. If I own the business and Don Don's one of my employees, and I want to write a life insurance policy on Don Don, I have to let him know, right? I can't just write a life insurance on Don Don without him knowing. Okay, it makes sense, but the reason these rules were put in place is because that used to happen. Several years ago, there were businesses that would simply go put life insurance policies on their employees without them knowing. Okay, so these rules came to be because of that. Okay, so you see there, look at the kind of the three bullet points inside of the third bullet point there. The employee is notified in writing of the intent to insure their life. Okay, that's number one. The second thing is the notice contains the maximum face amount. What are you going to insure? How much are you going to insure that employee for? Is it 500,000? Is it $1 million? The employee has to know that. Okay, and then the third thing that the employee has to know is that the employer will be directly or indirectly the beneficiary. Okay, the business is the beneficiary. So when we talk about key employee life insurance, in fact, let's just move on to that right now. When we talk about key employee life insurance, if you think about businesses, essentially all businesses rely on employees for the success of their business. Okay. Some employees are going to provide a much more critical role to contributing to the ongoing financial success of the business than others. We've all been there. We've all probably been sitting in an office and think to ourselves, man, what does Joe do all day? He doesn't do much, right? I'm much more of a asset to this company than Joe is. We've all probably been there. So think about those key employees. There are a lot of key employees out there that contribute to the ongoing financial success of the business. Okay. And the loss of one of these key employees could be really detrimental to the business's continuation. Okay. And so to help protect against the loss of one of these key employees' contributions and expertise, a business can purchase insurance, okay, on that key employee's life. This is a form of EOLI. Okay. So key employee is a form of employer-owned life insurance, and they are subject to those IRC 101J rules, those three things we talked about. Okay, so when you do a key employee life insurance, you have to let the employee know. They have to sign that they understand that the business is writing that insurance policy on them. Inside that same form, you're going to let them know what the amount is, and you're also going to have a paragraph in there that says that the employee understands that the business is the beneficiary. Okay. Now, because of this, you think about the employer. The employer, okay, the business retains all incidences of ownership. They pay the premium. And then again, they are the ones that are going to receive the death benefit. So if you don't remember anything else tonight about key employee, okay, I want you to remember this right here. The employer, the business, okay, they are the ones that own the policy. They're the ones that pay the premiums, and they are the ones that ultimately will receive the death benefit. Okay, they're the beneficiary. A lot of people get confused when someone new to the business hears key employee, they think, oh, let's go take care of our key employees. Key employee life insurance does not benefit the employee at all. Okay, it is 100% protecting the business. So that's the one thing I want you to understand about key employee life insurance. Protects the business, has nothing really to do with the employee, other than the employee signs away saying that they understand that the business is going to put a life insurance policy on them. Okay, all right. Let's kind of give you a little more details into the key employee. So again, this is a business planning strategy, which allows the business to hedge against that premature loss of a key employee. Again, as I mentioned up front, it is important to note and understand that this is a strategy. Okay, it's not a variety of life insurance. It's not a policy. It's not a product. It's not a product on its own. Okay, we're simply using life insurance to help fulfill this strategy. Okay, but the negative impact of the unexpected death of a key employee can be offset by the death benefit proceeds provided by the life insurance policy. And you think about it, this infusion, if this key employee were to pass away, this infusion of tax-free cash helps the business to economically stay afloat, right? And successfully transition from the loss of that employee until they can find a replacement. Okay, so if you look at this next slide, let's kind of talk about who is a key employee. Okay, and really a key employee can be considered as anyone who provides for the ongoing financial success of the business in some critical way. Okay, you can see some of the characteristics there. It could be an employee with some specialized skill set or knowledge base that is super critical for the ongoing success of the business. It could be someone in a sales capacity, right, who has a large customer base with a high impact on generating sales for the business. It could be someone who may be a source of capital and whose loss would damage the creditworthiness of the business. Okay, but the one thing I want you to understand when it comes to this is there is really no rhyme or reason to who is really considered who is considered a key employee. In other words, there's no rules that suggest that the employee has to make over $100,000 a year to be considered a key employee, or has to have a manager or director title to be considered a key employee. There's nothing like that. Okay, at the end of the day, it is going to be up to the small business owner themselves to let us know who their key employees are. Okay, as long as those rules are followed, they can put a life insurance policy on one of their employees. All right, so let's kind of give you an example of different methods on how you determine how much you're going to put on a key employee, how much life insurance. Okay, there's a lot of different ways. Okay, and we're going to talk about two. You see here this case study. This one right here is considered a replacement cost method. Again, there's a lot of different ways you could do this. In other words, again, we want to put life insurance on a key employee. How are we going to determine how much to put on them? Okay. I will tell you this, at the end of the day, it could be as easy as the employer saying, hey, I think my employee is worth $350,000 if something were to happen to him. I mean, it could be that easy. But there are ways that you can do it. There's different ways that you can do it that make much more sense than that. Okay, and the first one here is called the replacement cost method. All right, so if you look here, this is Gunther. Okay, and Gunther here, he works at a family-owned insurance agency. We're just going to call it FOIA, you see right there. And Gunther makes $150,000 a year, okay? And that reflects a premium which is above industry norm. So he's making a little bit more than the industry norm for what it is, for what he does, okay? As far as his experience and expertise. In other words, FOIA, they could go outside and hire a person for $100,000 to perform the same duties. Okay. However, it would take a new hire 5 years, okay, to reach the experience and that same level of expertise that Gunther currently has. Okay, so the way we do this with this replacement cost method to determine Gunther's economic value to FOIA, to the company, they're going to subtract the new hire salary from Gunther's salary. Okay, so the $100,000 subtracted from the $150,000, okay, that gives us $50,000, and then they times it by the number of years it's going to take to get him caught up to speed with what Gunther was doing. And they determined that was going to be 5 years. So this the simple math right here: 150,000 minus 100,000 equals the 50,000 times the 5 years. So they said that they're going to need a life insurance policy of $250,000 on Gunther if something were to happen to him. Okay, that is one method of doing it, and it's what we call the replacement cost method. Okay, I'm just going to go over one more real quick. This is what we call the contributions to earnings method. I usually see this when there's maybe a key employee who's in a sales capacity. Okay, and this is what the example is here. So this is Tammy. She also works at FOIA, and she has for her whole career. In fact, she was the first hire of FOIA. So she's been with them since inception. Tammy, she plans to retire in 10 years. Okay, and she has always been the top salesperson in the company. So think about it. If top salesperson, she's out there creating all these sales, and if something were to happen to her, there could be some detriment to the company. Okay, so anyway, at the next board of directors meetings, they discuss what Tammy's over contributions would mean to the company if she were to prematurely pass away. Okay, and the board estimates that her death would cause an average annual loss of $50,000. So the board of directors, they decide to apply for a key person life insurance policy. They work with a financial professional, someone like you, to determine the appropriate coverage needed, and they suggest this contributions to earnings method, okay, because Tammy is the top salesperson for the company. So what does the board do? What do they have to do? They have to send Tammy notice and consent to obtain the life insurance policy on her life. They have to let her know how much it's going to be for, and they also have to let her know that the business itself is going to be the beneficiaries. Okay. In this notice and consent, they disclose to Tammy that they're going to put a $300,000 policy on her life. Okay. They arrived at this amount by multiplying Tammy's annual loss, if something were to happen to her, that $50,000, by the number of remaining work years. We said that Tammy is going to retire in 10 years, so we take the 50,000, which is the loss if something were to happen to her, times the 10 years, okay? And sometimes they'll do a discount, some type of reasonable discount of interest, and they did that here. So what they did is they took that $50,000 times the 10, they did 6%, this reasonable interest rate, okay, and you see the math there, 500,000 times that 60%, that's how they got to the 300,000. Again, this is a little bit into the weeds. Look, when you have a case, we're going to help you with stuff like this. Your leaders, I know Don's done some cases like this. And again, it can easily be done by the business owner simply saying, hey, I think Tammy's worth $300,000. You don't have to go through all of this. There's just different ways to help you get there if you need it. Okay? All right. That is key employee. Again, the few things I want you to remember about key employee. You got to remember the rules when it comes to consent. We have got to let the employee know that we're going to do a life insurance policy on them. Okay? We've got to let them know the amount that it's going to be. We've got to let them know that it's the employer who's going to get the benefits. Okay? All right. So let's jump in to what you see here, executive benefits or executive bonuses. Okay? So now when you think about executive bonus arrangements, okay, the first thing I want you to write down is you might hear along your career or during your career as an agent, you might hear them referred to as IRC 162 arrangements. So just write down IRC 162. That's just the code in the U.S., the tax code. If someone ever says, hey, do you guys do IRC 162 arrangements? Just know that it's the same thing as executive bonuses. Okay, it's just kind of the proper name for it. Okay, but when you think about executive bonus arrangements, this is a way for a business to reward certain employees with a bonus, okay, to pay for their life insurance policy. Now, there's one other thing I want you to write down. It's called because the business they're going to need what we call a corporate resolution. Okay, so just write down corporate resolution. Okay, and what I'm going to do when we get done here is I'll send an example of what that looks like to Don. He can kind of distribute it to you guys. But you're going to need a corporate resolution to get through an executive bonus. And it's again. Let me just kind of back up and say this. When you guys are starting to do key employee executive bonuses by sale agreements, it is going to be super beneficial that you start to make contact with different professionals in your area, tax attorneys, people like that can help adopt and write up some of these this paperwork that you're going to need to do this, okay? Because Transamerica is there to help with the policy, getting the insurance, but we're not going to be able to help you adopt some of the paperwork that needs to be done, Okay, we have some examples that we can send you, but some of that paperwork is going to be have to be done up front before you even send that in to us. Okay, so make sure you start working with some other professionals in your area. Start hooking up with them. Okay, but look, these type of arrangements can help businesses. This is when we start talking about attracting top talent. And then not only attracting top talent, but retaining top talent by offering these executive bonus arrangements. Okay. Again, this is different from key employee life insurance. Okay. The business is not going to own the policy on an executive bonus arrangement. Okay. All right. Let's talk a little bit about how this works. Now, if you look here at this slide, this is what we call a single executive bonus arrangement. Okay, and the way it works is the employer, okay, is going to pay a bonus. They can pay the bonus directly to the employee, or they can pay the premiums directly to the life insurance company. Either way works. Okay. So if I want to put I want to put a life insurance policy again on Don. Let's just say he's my employee. Okay. One of my top talents. I don't want to lose him. So we talk about an executive bonus. Okay. I can pay him directly through his paycheck, and then he is going to turn around and pay the premiums himself. Okay. However, the way I see this mostly being done is the employer is going to simply just pay those premiums directly to the company itself, okay, rather than do it that way. Okay. If you think about this is what we call a single bonus arrangement. Okay. There's one other way we can do this, and it's what we call a double bonus arrangement. These are becoming more popular. Okay, so if you look here, this is just a case study. This is Enrique. He's a top executive at FOIA, and he was offered an executive bonus arrangement. Okay, his premiums for the life insurance policy are $13,750 a year. So that's the premiums for the life insurance policy that we're going to do through Transamerica. Okay, yes. If we want to just pay $13,750 to Enrique, we can do that, but he's going to be taxed on that. So it's really not a fair bonus to Enrique. So what a lot of companies are doing now is they're doing what we call a double. They're bonusing up, right, to make sure that when he's taxed, he still has the premiums in his pocket to pay his premiums. Okay, so again, premiums are $13,750. We're going to bonus him $25,000 because once we take the 45% of the tax bracket that he's in, it's going to take it down to that $13,750 that he still has to pay the premiums. If we don't do the double bonus, it's the single bonus we just talked about on the page before. Okay, we're just giving him the $13,750. He still has to pay the taxes, but then he turns around and pays those premiums. A lot of companies, to really help attract and retain these key employees, are starting to go to this double bonus to really help attract that top talent. Okay? Now, again, not going to get too far into the weeds, but there's one other type. So we got the single bonus, we got the double bonus. And then every once in a while, you'll see something called a REBA, a restricted executive bonus. Okay. Here's the deal with these. Okay. I'm not gonna get too much into the weeds because I don't see a whole lot of them. But some businesses may want to maintain a little more control over the executive bonus arrangement that they've entered into with the employee. Okay. They might want to maintain a little more control over the cash value, or how often you can raise the death benefit, things like that. And if they do, then they will hook into what we call a restricted executive bonus arrangement. Okay, again, I don't want you to get too far into the weeds. Maybe not even take note of this because, again, I don't see a whole lot of it, but I just want to at least mention it. If you ever see a REBA or someone wanting to offer a REBA, you'll know kind of what it is. Again, it's the business wanting to maintain a little bit more control. And they're going to establish some limitations on that employee while that employee is still employed. Okay. But here's what I want you to understand when it comes to executive bonuses. Okay. It's complete opposite with the key employee. With executive bonuses, it is the employee, not the employer, but the employee who owns the policy. Okay. It is the employee who gets to choose who the beneficiaries are. So it is literally it's their own policy, and the company is simply paying a bonus to help take care of those premiums. Okay. And because of that, again, not going to get into a whole lot of taxes when it comes to these, but because the employer are paying the premiums and the employee is the one who is getting the benefit, those premiums are tax deductible to the employer. Okay? All right. Let's get into what we call business succession planning. All right. Let me go back here. All right, so when we talk about business succession planning, there's gonna be a couple different things you're gonna take note and kind of hear along the way. Okay, if you think about business owners with 2 or 3 business owners, it is important for these business owners to understand what would happen should either the owner or one of his co-owners die with closely held stock, right? If you think about it, without a plan, that stock will typically go to who? It's going to go to the surviving spouse or the heirs of the estate, okay? And even if the surviving spouse or the heirs don't have a controlling interest, they could demand dividends on the stock, or they might want to have a say in company management, okay? For most businesses, this means the surviving shareholders have to negotiate a purchase price of the stock that can often lead to tension and even legal battles, okay? So we got to be careful there. And for the deceased family, it means not only a loss of income, but it also means a loss of wealth, as the heirs might have to ultimately sell the stock at a price they feel is under current value. Okay, so these concerns can be addressed through what we call buy-sell agreements. Okay. When you think about a buy-sell agreement, it is simply a plan that is put in place to provide for a smooth transition of control and ownership by outlining the terms of purchase of the deceased owner's shares. That's all it is, okay? In addition, the buy-sell can provide liquidity to the deceased owner's family, okay? There are a couple different ways that you can do a buy-sell agreement. You see them there, okay? You can use what we call a cross-purchase plan, okay? You can use what we call a stock redemption plan. We're going to talk about these. Or you can use what we call a wait and see. That's another option. Usually that's going to be implemented when there's kind of uncertainty with they're not really sure what they want to do. So let's talk about each one. Okay, when you think about a cross purchase buy sell agreement, as the name implies, a cross purchase strategy is one in which all the owners of a business agree in advance to purchase proportionate shares of another owner's interest in the business if the other owner passes away, if they die. Okay. A convenient way to fund a cross purchase agreement is to have each owner purchase a life insurance policy on the life of the other owner. So you see in this example right here, you got John, you got Kate. They each own 50% of the business. Okay. And Kate's going to buy a life insurance policy on John's life. John's going to buy a life insurance policy on Kate's life. That way, if one of them passes away, that benefit's going to go to the surviving owner, and they're able to purchase those shares from the family to take control over the business. Okay. One of the drawbacks that business owners need to be aware of when considering this cross purchase form, okay, is that it's probably not going to be ideal for businesses with a large number of owners. Okay, usually you're going to see a cross purchase agreement when there's 2 or 3 owners, okay, in the picture. The reason for that, if you think about it, what we're doing with the cross purchase agreement is every owner is purchasing a policy on every other owner. So think about it. Let's just say you had 5 owners in the business, right? You could have 25 or 30 different policies being purchased. And if you do that, it could be just kind of a nightmare trying to figure all that out. Okay, so when that happens, we usually go to what we call a stock redemption, or what we call another name for stock redemption buy sell agreement. You're going to hear it referred to as a stock redemption. You might hear it referred to as a entity purchase plan. Okay. This differs from the cross purchase strategy in that it's the business itself agrees to purchase the stock from the deceased business owner's estate. Okay. So the main benefit of this arrangement is that the corporate funds are being used to purchase the life insurance policies. Okay. Thus, you're avoiding the need for those owners to pay the premium costs out of pocket. Okay. This strategy right here also ensures that the premium cost is spread among all the owners according to the percentage of the owner's interest. Okay. And lastly, this arrangement requires the purchase of only one policy per owner, really avoiding the need for the purchase of multiple policies. Okay. So again, cross purchase, it's the owners buying the life insurance policies on each other. Redemption buy sell agreement, it's really you're using the business itself to purchase the policies on all the different owners. Okay. All right, let me go down. So if you think about the role of life insurance, right, and how this kind of applies to what we're doing here, setting up a buy-sell life insurance agreement is really the great first step. But the next step is to determine how those surviving owners or the business is going to finance the buyout of the deceased owner's interest. Okay. Some people like to use cash on hand or whatever the case is, but obviously the best way is to put a life insurance policy on the other owners. It's simply the best way to set up these policies. If you think about, let me get back in here. Let's skip through this just because of time here. When you think about business evaluations, okay? Again, I don't want to get too much into the weeds here, but there are several reasons why for that you need to help a person value their business. Okay, really, there's different common reasons, and the list is not certainly complete. But one of the most critical components to the success of a buy-sell agreement is really pegging the valuation of the business when the agreement is entered into. Okay, and a business valuation is really going to make it possible to determine the value of the deceased owner's interest when that time comes. Look, there are when it comes to determining the value of a business, you can see there's look on the left hand side here. There's a few different ways you can do it yourself. I would not suggest that. There's all kinds of different software calculators that can help with that. But I'm telling you, the best way to really evaluate someone's business is to get a third party involved to do it right. Hire a CPA, professional third party business valuation firm. They're out there. You need to partner up with these companies to give your clients the best valuation. And then, so now that we've talked through this a little bit, we've talked through key employee, we've talked through executive bonuses, and we've talked through business succession planning. Now you can kind of think about when you go into a small business, think about that, right? Think about all the different questions that you can ask, and maybe coming out of there with 2 or 3 or 4 different policies. Key employee, let's retain their top talent. 2 or 3 different business owners, are they prepared if something were to happen to one of them? Let's talk about that succession planning. Oh, by the way, right? These people probably have families. Are their families taken care of? Let's make sure we're leaving a legacy for their families if something were to happen to them. Okay. So again, going in talking about small business, but we're coming out talking about their families as well. You potentially coming out with 2, 3, 4, 5 different policies in one swoop. Okay. So I know we're short on time. I talked to you about some of the resources. The best advice I have is there's this as well, this Transamerica Advanced Markets. But the absolute best place to kind of go back through what we've talked about and just kind of learn it on your own is the Transamerica Agent Central website that I took you to first. Okay. Look, again, I know it's a lot. I went through a lot tonight, and some of you might be scratching your head thinking I'm a little lost right now. I can tell you that that's okay, because these things can be difficult. The best advice I have is, if you have an opportunity to talk to a small business, make sure you get your leaders involved. Dons and the SMDs, your trainers, whatever the case is. But then know that we're here to help as well. Okay. And I'm telling you, I don't know all the answers. I have to sometimes go to our advanced marketing team to get some of the answers, because we can't talk tax advice. So, there's a lot of, when you start talking about, is this an S corporation? Is this a C corp? Whatever the case is, a lot of those questions come up that we have to go to our advanced marketing team for. So don't feel like, if you're feeling kind of lost, if you're feeling like, man, I don't understand some of this, perfectly normal. Just know that it is perfectly normal to feel kind of lost when we talk about this. This is more of a advanced topic, but important to understand, because undoubtedly at some point you're going to start talking to people that own their own business. And why not start asking some of those important questions? Hey, do you have a key employee that if something were to happen to them, your business would suffer? I got something for you, right? Or do you have that top talent you're afraid of losing? I got something for you. Let's talk about that. Or do you have, I know you. I know you have another owner in the business. Are you prepared if something were to happen to one of you? How are you going to pass that along? So there's a lot of good questions, a lot of good stuff, but don't feel overwhelmed. It's going to come as you have more time in the business and learn about this. Okay. So Don, I'll turn it back over to you. We got maybe a couple minutes, I think, for questions.
All right. Thank you, Rick. I know some of you have a question. Let's do maybe 2 or 3 questions. No question. Go ahead,
No.
Jay.
No, I think somebody typed in a question earlier if an employee resigned or something. I think someone, I just saw it popped out earlier. I don't know if he's
If or when the employee stops
okay,
working at the company, can he keep the insurance?
Okay, so good question. So let's go back to the key employee first. Okay, when a business writes a policy on a key employee, okay, it is 100% within their right. Because remember, who is going to get the benefit if the key employee passes away? It's the business on the key employee, right? So let's just use the example of Don. Don, my key employee, and he, after 10 years, I put a $500,000 policy on him, and 10 years after, he leaves the company and goes somewhere else. It is perfectly within my right as the small business owner to keep that policy on Don. Even though he leaves, I could still pay those premiums and collect the death benefit 10 years down the road after Don leaves, okay? So that is key employee, okay? As long as the business keeps paying the premiums, they have every right to collect on that death benefit if something happens to Don down the road, all right? They don't need to. They could simply quit, if Don leaves, I could quit paying the premiums. Everything just kind of ends right there. Okay. When it comes to executive bonuses, okay, if the employee leaves, the only way they can keep that policy is if they now turn around and start paying those premiums. They would have to take over, because again, remember, an executive bonus, it's the company paying the premiums, but it's the employee who's receiving the cash value and who is receiving the death benefit at the end of the day. Their family, right? So if they were to leave with an executive bonus, they can leave, they can keep the policy, but they would have to obviously take over the premiums at that point. The company's not, they're not going to keep paying those premiums.
Okay.
Okay. Good. That's a good question. It always comes up.
Thank you, Rick. Sherry, go ahead.
I have 2 questions, Rick, particularly for the executive bonus arrangements. So for the executive bonus, can it be any type of life insurance like IUL, term, or does it have to be? So it can be different.
Yeah, that's a good question. Yeah, again, it doesn't matter. Again, it's not it's simply a strategy. So we're fulfilling this executive bonus arrangement or this strategy with life insurance. And you can use term, you could use our term LB, you could use the IUL, you could even use a whole life if you wanted to.
Okay.
It just depends. But that's another good question, Sherry, that always comes up. But yeah, any type of life insurance you can use for this strategy.
Okay. And then another question, same thing on the executive bonus. Do they have to be an employee of the business, or can just be a part owner and then they can?
Yeah, so there are ways that you can kind of incorporate owners. Kind of a different topic and different discussion, but you can. But there's some tax consequences involved with that are kind of probably not for this discussion, probably more advanced. But you can do executive bonuses for the owners as well, not just employees.
Okay. All right. Thank you.
Yep.
Rick, I have a question.
Hi, Laura.
Yes. For a sole proprietorship business that has been structured as an LLC, So, what would be the requirements for the employer and for the employee as far as tax filing is concerned?
Okay, so here's what I'm going to tell you, Laura. Because as much as I want to get into this, and I probably could a little bit, we have been really warned from our superiors that I'm not a tax. I cannot talk to you about tax advice. That's when I really encourage you to get those tax advisors in your corner that you guys can use. If you want to jump on a call with one of our advanced marketing guys, they, I think, are able to talk more about it than I am. But we've gotten in trouble a little bit by trying to go too deep into the tax advice when it comes to this type of stuff. So I'm going to stay away from that question if you don't mind.
Oh, no problem. No worries. Thank you.
Okay. And here's what I will tell you, Laura. If you go to the Agent Central website that I referred to in the very beginning. In fact, if some of you were not, let me just pull it up one more time in case some of you missed it. It's right here. So if you go to, I'm just going to pull it up from the beginning. If you go to Agent Central,
Rick,
we get one more time.
I sent them a link for this. So once
Yes.
they click that link, they can see this.
Yeah, don't send it to our group already.
Yeah, if someone wants to take a copy, just put it in the chat. But again, if you go there, and then you go to resources, and you come back down here to the here's the advanced market section. And again, one of them talks about small businesses. If you click on here, you're going to see where if you keep scrolling down, it's going to start talking about some of the tax advice right here. So like right here, taxation on employer-owned life insurance. So you can come there, and I think it will kind of get into that on this website right here.
All right. Thank you, Rick.
Yep.
Okay. All right. I know you guys have a lot more questions, but we want to respect Rick's time. It's already 3 past the hour. And yeah, definitely for those questions that you ask, that's why we always have disclosures. Remember, whenever we sit down with our clients, we always tell them we're not tax preparers, we're not CPAs, and we're not lawyers. So we don't give those advice. And what I usually do is whenever I sit down with business owners like this, I encourage them to have a conference call or a Zoom meeting or maybe an in-person meeting with their accountant and kind of verify that because it's usually their accountant who's going to prepare all this, and they usually give the advice to them. And we have a lot of this executive plans that we put in place, and accountants usually verify and validate whatever we ask them or we recommend to them. Okay. So again, always put a disclosure there. Again, the idea of this training, this is advanced training. Remember, after you get your license, the very first policy that you wrote, okay, your IUL policy, or very first IUL policy. Remember how hard that was, okay? But after 10 or 20 accounts, it gets a lot easier. Okay, so this is the same thing. You gotta write your first account. Okay, but what I mean by you're gonna write your first account, that means you're gonna start the conversation, but you're gonna bring trainers, or use the Transamerica's resources, like what Rick was saying. As long as you start a conversation, have a meeting with them, bring all your leaders and trainers, and then we go from there. And maybe after they close, then ask to write those account, and that's the easiest way. At least for me, that's the easiest way that I learned about that. When I want to learn this executive plans so bad, I wrote my wife's account as an executive plan, and by doing that, I went to a lot of mistakes, and that's how I learned. Okay. So if you haven't written any business account yet, the goal of this training again is just to let you know that this is not the IULs are not just for individuals, we can use it as not as a product but a strategy for those like what Rick said, for those business owners. Okay, so again, do your join on share, do your very first account, and I can almost guarantee you it'll be a lot easier for your next account. Okay.
And real quick, Don,
Go ahead.
I see Dan's question. I didn't think I answered Dan's question. He asked who can do a rebate. It's really up to the company. When they start doing a executive bonus, they're the ones that are going to determine whether it's a single, double, or a rebate. So it's really the company. Any company can do it. Dan is the answer to that. They're the ones that are going to decide what type of what type of executive bonus it is. And then his other question was, as an owner for key person, can the employer use the cash value? And the answer to that is absolutely yes. If it's a permanent life insurance policy that's going to accumulate cash value, they're the owners of the policy, so they can use that cash value how they see fit. Absolutely.
Mm-hmm. Rick, maybe one last question, because this was brought up in one of our leadership meeting, and then a guy told me from Canada. I don't know if that's true. A whole life policy, if Transamerica is offering that you can actually use the whole life policy, and after paying the same the premium the first year, you can actually pull it out as a loan, 100%, and still making money. Is that Transamerica have that in Canada?
Donna, not that I can check, but not that I'm aware of.
Yeah.
Yeah, I don't know about that. I've never heard that. So I would say no, just because I've never heard that.
Okay, that's the infinite banking concept, and one of the agents in one of the leaders in Canada.
Yeah, and look, hopefully you guys. The one thing I will say about the infinite banking or be your own bank concept is just be careful. Just be super careful with what. And you guys have probably seen WFG. I mean, WFG's come out and said they don't want you guys doing these bank concepts. So just be careful with that. If you do use it, just make sure that your clients really understand how those things work, because they can get in trouble if they don't understand that.
Yeah.
Yeah.
Okay. All right. I guess that's all, Rick, for tonight. So thanks again. And let me just summarize. This how I understood it the first time is that if it's executive bonus, it benefits the employee, and if it's a key employee, it benefits the business. The payer is always the business. That's what I explained. But the benefit, it depends on if it's executive bonus or key employee. So I started from that, and then I kind of build on the info from there.
Yeah.
All right.
Yeah.
Okay. So again, thank you. We'll see you again next Monday for another
Okay.
product training.
All right. See you guys.
Thank you.
Good night.